Good evening, everyone. Time for another silver update. This is the 30-minute chart of silver provided by netdenia.com. You can click on the link below. Now you can see that the saucer formation that I've been talking about is starting to rise out of the upper spike that we had early on, and we're now at 35.06. Normally, from my experience, I'm not going to go by the technical analysis that others have done, but just from my own experience, the cup formation, the saucer formation, the flag formation, these are the most bullish formations. And normally, in my experience, this particular type of formation, the saucer formation, has about an 80% likelihood to resolve to the upside, where it about a 20% chance it will resolve to the downside. So the formation is very bullish at this point. Of course, if we go over to gold, we can see that it's even more bullish because gold has broken out above the 1790 point. If we pull out farther, we can see we have just a couple of resistance points that are just a little bit higher than what we have. The first one actually is a little bit lower here now at about the 1790 point. If we pull out one more, we can see the one behind it is right here, and we're talking about 1800, 1801. So we've already penetrated this resistance point, and it looks like if we pull out the MACD, we're just starting to turn up, so it's quite possible we could actually blast through this one, which will really only leave about a 2-month period where we got that 1920 high. So it wouldn't surprise me at all to see a blast off through those areas, through this area and through that area in quite rapid succession. And I would expect that if that does occur with gold, silver will probably follow, and you can see we have a long way to run with silver, as I pointed out many times. Now, let's get over to the questions of the night. These are both going to impact the topic of the night, and you'll see that when we get to that. So the first one is from Silver Miner, and this is Mark Faber's view on silver manipulation. Hi, Brother John. I'm interested in everything silver. Love your video updates. Nice one. I recently listened to a radio interview with Mark Faber where he states that he is on the board of different mining companies and that he asked the people involved in the mining, the largest shareholders, do they believe that JP Morgan is manipulating the market down? And they said no. He goes on to say that silver mining companies mining companies go to JP Morgan for loans, for example, 100 million pieces of toilet paper, I mean dollars, and that in return they'll pledge silver and gold to them. It's basically a loan against future production, and that is their reason for shorting the metal. He says that he doesn't believe that the price would be higher if they were not shorting. This view seems to be contrarian to the widely held view out there, but then again, Mark Faber has made an extremely successful career from having different views from the majority. I would be interested to hear your view on what he has to say in this interview, and here's the link. So what I would have to say is that Mark Faber has made a lot of money by being a contrarian, but then again, Mark Faber hasn't made a lot of money by calling out the powers that be. So we'll leave that as it is. But I will point out that some of the largest gold miners, and we know, I believe Barrick is the largest one. We know that Barrick, because of its board and other entities, put on a hedge against gold, a continuously rising position against the hedge. The hedge was against the rising price, and Barrick, I don't know what the numbers are, but you can figure them out. Barrick lost billions of dollars by shorting its own commodity. Now you tell me why that would happen. I have to tell you that the only explanation I can think of is that Barrick was controlled by those who are opposed to a rising gold price. In other words, the people who can print paper money have the ability to buy out anything they want, including mining companies, and they have the ability to take the board over and make those companies do something that's not in their interest. So I don't really put a lot of credibility on what people on boards of mining companies say. I think that there's a very good chance that all of the people, all of the officers, all of the board members of all mining companies in the entire world are already compromised by a green paper that can be printed at will. We'll leave it at that. Next question from George Silver. Why aren't central banks buying silver? Dear Brother John, why aren't central banks buying silver? To answer my own question, I think you would say that there isn't enough silver for banks to enter the market. Is this true? This is beyond true. It could be said that there isn't enough gold for the central banks to enter the gold market, but they do and are doing so in ever-increasing amounts. Surely it has nothing to do with the amount, only the price. Why is silver a target for suppression by the central banks? Why would they be concerned if the price was to equal gold? In fact, wouldn't this be in the interest of the central banks to hold a more valuable asset? It's often said that the price of silver is kept low in order to make fiat currency look good. Why? Most people outside the silver world wouldn't care less about the price of silver if it was to increase. Maybe a few would see an opportunity, but most people wouldn't even think about it. Once again, I find myself asking the same question. If silver is the most undervalued asset in the history of the world, why aren't the bankers grabbing every physical ounce they can get their hands on? Could it be silver is a red herring? No. Silver's not a red herring. Silver is the enemy of the central bankers. The central bankers hold gold. The central bankers suppressed silver. The central bankers demonetized silver. And the central bankers know that silver is their Achilles heel. It is the silver bullet that slays them. It is the arrow. It is their doom, because silver is the people's money. Gold is the bank's money. Yes, they're both suppressed, but silver is suppressed by magnitudes more. In fact, such a magnitude that it's actually incomprehensible. And I'm going to show that when we look at the main topic of the night. So let's go over to that. We're going to start off with an open letter to Ted Butler. But before we read that, we want to read some of the Ted Butler letter, the most recent one on 24-hour gold. And I'm going to jump in the middle. The bottom line is that after 4 years, no real response has been offered by those who should have responded. There is a good reason why there has been no response by JP Morgan, the CFTC, the CME to persistent allegations of a silver manipulation, because to respond risks expanding the discussion further. If they say anything, it risks truly opening up a legitimate debate. That's because they, JP Morgan, the CFTC, and the CME, know there is no legitimate explanation possible. So blatant is the short concentration by JP Morgan that any attempt to legitimately explain it away would invite additional scrutiny. By remaining silent, all three entities effectively muffle debate. There's no excuse possible that would permit JP Morgan to hold 31% of the entire net COMEX silver minus spreads, or the four largest shorts to hold 49% of COMEX silver as of the most recent commitment traders. Just to give you a sense of the lopsided nature of the big shorts compared to the big longs, on the same methodology, no spreads, the four biggest longs hold only 13.4% of the COMEX silver market. JP Morgan alone holds a position more than 2.3 times larger than the four biggest longs combined. That's obscenely manipulative. Plus, JP Morgan has been virtually the only active short seller on the COMEX silver for months. So we'll stop there and jump over to the Acting Man article. This is from Keith Weiner. It's an open letter to Ted Butler. Dear Mr. Butler, I read your article about the silver manipulation. That's the one we just read at 24-hour gold. I'm responding as someone who wants free markets. I want to make one thing clear before I proceed. We have no free markets anywhere today. Without constant government intrusions into the markets, the paper currencies would have collapsed already, and there would not be a price of money, i.e. gold and silver quoted in terms of dollars. In this sense, all markets are manipulated by the central banks and their regime of falling interest rates. I'm compelled to respond to your allegation of manipulation because I believe you mean it as the naked selling of silver futures, and others also include gold futures in the same scheme. This is not occurring, and I have data to prove it. You express the central issue as follows, quote, none of this makes much sense, as who would buy or hold such a giant physical position and super aggressively short it in a concentrated manner? Why indeed? Why would someone buy a bar of silver and then sell a future against it? I reframed the question in this way to make it clear why someone would do it: to make a profit. To carry a commodity means to buy the physical good and simultaneously sell a future against it. The market is offering a profit to the warehouseman. It is giving him a signal in the form of a positive spread between the spot market and the futures market. It is saying, please hold this good for a while so consumption is even throughout the year. This is part of what I referred to earlier when I said the whole system is manipulated. In a free market, there would be no such thing as a futures market in money itself. The high stocks to flows ratios, inventories divided by annual mine production, means there's no value added by a futures market in the monetary metals. In any case, let's look at the spread mechanically. So he begins to look at the spread, and I'm not going to go any further. I encourage you to look at that, and we're talking about backwardation. And he says here, if they sold massive quantities of futures, the basis would go negative. To oversimplify slightly, this is called backwardation. Gold has had no major backwardation other than temporary backwardation. However, silver did have it. All long-dated futures were backward dated for a period of time. This was when the silver price rose from $18 to $40. This is the opposite of what the manipulation theory would predict, but is what basis analysis predicted. Backwardation was not caused by naked selling of futures, which is supposed to drive down prices. It was caused by a scarcity of the good in the physical market, which relentlessly drove up the ask on spot. Since then, backwardation in silver has been receding and is all but gone today. So that's what we want to look at. That's the essence of the argument that Acting Man is making against Ted Butler. And I'm going to contend that both are wrong. Both are actually dead wrong. So let's start by looking at the NYMEX silver futures contracts. You can see, if you know what silver futures are, they go out to months of delivery, and you can see that our months go all the way out to about 2017. You can see here that the closing price of the last contract that's available to us is $34.61, and the current is $34.70. So in essence, the price out for the next 5 years plus is flat. Now, if this were a backwardation scenario, you would see this price higher and the outlying prices lower. And if we were in contango, you would see this price lower and these prices much, much higher. That is explained by the carrying costs for that contract. So we're basically flat now, and the price is flat for the next 5 years. And the main thing is to show you why all of this is utter nonsense. And the talk about contango, backwardation, flat markets is all really meaningless when you understand the extent of the manipulation. And I'm going to show you that here. Now, we're going to start by looking at the volume. We want to clear this off and just look at the raw volume in this is we want to go to the daily, and so we're going to get daily volumes, and then we're going to compare to the news reports to try to get a reasonable view of what type of volume we're talking about. So you can see we're going to disregard all of this volume here. during this huge burst. And just look at this volume right about here. If we take the top tick of the recent volume for the last, we'll say, second half of the year, we're talking about 200,000 contracts a day, roughly, being traded in silver. Now, we know that silver is a 5,000 ounce contract, so we're talking about 5,000, clear this out, we're talking about 5,000 times 200,000, and you can do the math in your head. So we're talking roughly 1 billion ounces. So 1 billion ounces of silver is a rough estimate of the amount we're trading per day in these futures and the various months that we're seeing here in INO. The forward month is going to be the most active. Then we're going to go out and it skips December next, and there's major active months. So we'll just take this at face value, and I'm going to confirm this next in another article. But based on those numbers, with the 200,000 contracts and the 5,000 ounces, we're talking about 1 billion ounces of silver trading per day. Now, if we go to an article that appeared in April of 2011, this is reported about record trading volume for silver. San Francisco Market Watch. Silver futures saw record trading volume on Monday. The CME Group said in a press release Tuesday. On Monday, trading of silver futures reached 319,000 contracts, surpassing the prior record of 200,000 contracts set on November 9, 2010. So the high was 300,000 contracts. We know from doing the math that that's roughly 1.5 billion ounces traded in one day. So let's look at the math on the calculator and figure this out to see how much of the volume is paper and how much of the volume is silver. So let's use that 1 billion ounce amount, and we know from looking at it every day that about 750 million ounces is the mined amount of silver per year. It's going to equal roughly, we're just going to say 2 million ounces per day. So we're going to take that 2 million and we're going to divide that by that 1 billion. To get the ratio. And you're going to see that the ratio is 1/5 of 1%. So of this silver volume that you're seeing traded every day, 1/5 of 1% of this silver is real silver. So 99.8% of all the silver traded every day, day in and day out on the silver futures market, 99.8% of the silver traded doesn't exist. Now, that's silver that is short. That's silver that is long. That is both of those positions. It really doesn't matter whether you're talking about JP Morgan's position. It doesn't matter whether you're talking about backwardation. It doesn't matter whether you're talking about the longs, the ones that Butler describes, the vipers and the traders and the hedgers and all these people. The main point is this, that 99.8% of all of the silver that trades every day does not exist. And so that really makes it irrelevant. It doesn't matter whether or not you're in contango. It doesn't matter whether you're in backwardation. It doesn't matter at all because the entire market is fake. You can't appeal, as Acting Man has appealed, to the fact that backwardation isn't occurring. They already control all backwardation and all contango. They've used paper money to buy all of the mines, to bribe the boards to suppress the price. There is no real measure of the price of any of these assets, gold and silver. There's no true measure of them, certainly not this market. And at the current time, this market corresponds with the physical market. That's just an anomaly. That is going to break free, and the physical price will disconnect from the paper price because the paper price is 99.8% fake. And when that price disconnect occurs, it doesn't matter whether there's backwardation, forwardation, contango, even prices. All that stuff is simply nonsense. It doesn't matter. Everything you see is fake, and the true price of silver is hundreds, thousands, and even potentially 5 digits. And we'll talk to you next time.